If I told you there was a retirement account that was legally allowed to cheat the tax code, an account that gives you a tax break when you put money in, grows completely tax-free, and lets you take money out without paying a single cent to the IRS, you'd probably think I was making it up. Because think about it, a traditional 401k taxes you when you withdraw. A Roth IRA taxes you before you contribute. The IRS always gets their cut, except for one specific place. It's called the HSA, Health Savings Account. Most people treat this like a boring debit card for buying cough medicine, but the wealthy treat it as the Super Roth, a stealth retirement vessel that is mathematically superior to almost every other investment vehicle in America. Today, I'm going to show you exactly how it works, the specific shoebox strategy to maximize it, and a few dangerous mistakes you have to avoid. Let's dive in. First, let's get the definition out of the way. An HSA is a tax-advantaged savings account available to people who have a high-deductible health plan. Think of it as a deal you make with the insurance company and the government. The insurance deal, you agree to pay a higher deductible, meaning you pay more out of pocket before insurance kicks in. In exchange, they lower your monthly premiums. The government deal, because you are taking on more risk, the IRS lets you open this special savings account to pay for those costs with pre-tax money. Eligibility check. You cannot just open one because you want to. For 2026, your health plan generally needs a minimum deductible of roughly $1,700 for an individual or $3,400 for a family. If you have one of those gold-plated plans with a $200 deductible, sorry, you're out of luck. But if you do qualify, you have access to the holy grail of taxes. I call the HSA the triple threat because it's the only account in the U.S. tax code that hits the tax trifecta. Benefit number 1, tax-deductible contributions, tax-free in. Any money you put into this account reduces your taxable income for the year. If you earn $60,000 and put $4,000 into your HSA, the IRS taxes you as if you only earned $56,000. That's an instant guaranteed return in the form of tax savings. Benefit number 2, tax-free growth. This is where people get confused. They think an HSA is just a cash savings account at a bank earning 0.1% interest. Wrong. Most HSAs let you invest in the stock market, funds like the S&P 500. While your money is invested, you pay zero capital gains tax and zero tax on dividends. Benefit number 3, tax-free withdrawals, tax-free out. This is the finisher. If you use the money for qualified medical expenses, doctor visits, dental, vision, hearing aids, insulin, you pay zero taxes on the withdrawal. Do you see the magic? Traditional 401k, taxed at the end. Roth IRA, taxed at the beginning. HSA, never taxed. Now, here's how the rich use this account. They don't use it to pay for doctors. If you go to the doctor and get a $200 bill, most people swipe their HSA debit card to pay it. Do not do that. Instead, follow the shoebox strategy. Pay with cash, pay that $200 with your personal credit card, get the points or miles, and pay it off with your normal checking account cash. Leave the HSA alone. Let that $200 sit in your HSA invested in the S&P 500, growing at 8 to 10% a year. Save the receipt. Take a picture of that medical receipt and save it in a Google Drive folder labeled HSA Receipts. Reimburse later. The IRS doesn't have a time limit on when you can reimburse yourself. You could pay that $200 today, or you leave that $200 invested. In 30 years, at 8% growth, that $200 grows into about $2,000. In 30 years, you take out that old receipt from 2026 and you write yourself a check for $200 tax-free. The remaining $1,800, that's pure profit that stays in the account to keep growing. The number one fear people have is, what if I'm super healthy and never have medical bills? Is the money stuck? One truth we all agree with is, for most of us, medical expenses are inevitable. Most likely, medical expenses only go up as you grow older, so your money will not be stuck. This is the ultimate safety net. What's more, once you turn age 65, the HSA unlocks. It effectively turns into a traditional IRA. If you have medical expenses, it's still 100% tax-free. But if you use it to buy a boat or groceries, then you just pay regular income tax on the withdrawal, same as a 401k, but the 20% penalty completely disappears. So the worst case scenario is a 401k. Best case scenario is a tax-free super Roth. Let's put real numbers on it and make the advantage obvious. For this example, let's use the following assumptions. You can change the number based on your situation. I will put the calculation in the description. Time horizon, 30 years. Annual HSA contribution, $4,400. Growth rate, 8%. Total medical spending over 30 years paid out of pocket, $60,000. Marginal tax rate while working, 24%. Marginal tax rate in retirement, 22%. If you use HSA as a retirement weapon, your effective value after 30 years is about $512,206. If you invest the same $4,400 per year in a taxable brokerage instead, your effective value after 30 years is about $366,148. The final difference between HSA account and regular brokerage account is about $146,058 from the same annual cash flow. This is a pretty big difference. Now, before you get all excited about the benefits of HSAs, there are a few traps you need to know too. Trap number 1, the Beneficiary Bomb. If you are married, list your spouse as the beneficiary. It transfers to them tax-free. But if you list your kids or anyone else, the entire account becomes taxable income to them the day you die. It loses its tax shelter immediately. So spend it down or leave it to your spouse. Trap number 2, FICA taxes. If you contribute to an HSA through your employer's payroll deduction, you avoid FICA taxes, Social Security and Medicare. If you contribute with your own bank transfer, you don't save that extra 7.65%. Always contribute through payroll if you can. Trap number 3, no receipts saved. HSAs let you pay medical expenses now and then reimburse yourself years later tax-free. If you have no receipts, no documentation, then you lose tax-free withdrawals. Without records, you lose one of the most powerful features of HSAs. So, keeping all the medical records is very important. Trap number 4, choose HDHPs just for the tax break. People hear HSAs are triple tax-free, so they pick the cheapest HDHP, without realizing higher deductible, higher out-of-pocket risk, medical bills hit before tax benefits help. If you can't comfortably cover the deductible, the HSA tax benefit may be wiped out by stress, debt, or skipped care. People who live paycheck to paycheck should think twice before choosing HDHPs just for the tax break. Trap number 5, contribution only. Some people open an HSA and contribute to the account, then just leave the money in cash earning whatever the interest rates apply. Meanwhile, inflation eats it and opportunity cost explodes over decades. You need to know HSAs shine when invested, not parked. Should everyone open an HSA? The answer is no. It really depends on your own situation. But if after understanding all the pros and cons and you still decide to start an HSA this year, consider maxing it out. For 2026, the limit is roughly $4,400 for individuals and $8,750 for families. Congratulations! You found the only place in the world where you can get a guaranteed tax deduction, tax-free growth, and tax-free spending. If you found this helpful, hit that like button so the algorithm knows. Thanks for watching.